Hi, I am Mr. James. Welcome to Mr. James' accounting tutorial. Today we will be looking at Accounting Unit 1, 2016, Paper 2, Module 2. So let's get right into it.
First, we read what is required. Part A. Prepare a partnership statement of comprehensive income for the year ended 31st December 2015, including as much detail as possible. Second, prepare a partnership statement of changes in owner's equity for the year ended 31st December 2015.
A Sean and Amin Partnership Statement of Comprehensive Income for the year ended 31st of December 2015. First, we put in the sales, and that is 75,000, the net accounts receivable for 12 months, and then we less the cost of sales from that. We get the gross profit of 25% of the sales being 225,000. Next, we calculate the net profit of 15% of the sales, that is 135,000. And then we take the difference between the gross profit and the net profit. We get $90,000 as our expenses. The cost of sales, we take the sales of 900,000 and we minus the gross profit of 225,000, and we get cost of sales 675,000. And then we put in the inventory at the end of December, 137,500, and we add back that to the cost of sales. We'll get the amount that is available, 812,500. We put in the inventory for the 1st of January 2015. We take the ending inventory of 137,500 and we will multiply it by 10 over 11. We mark it down to the fall in inventory by 10%. And then we put in the purchases as a balancing figure of 6,107,500. Okay, and I went through that quite rapidly. You may want to check through the calculations and see how I got it, and listen to the commentary. Okay, in particular, you should check into this here to see how I got the 125,000. Okay, let's move on to the next part. The statement of changes in owner's equity. First, you have to do the workings for the current account, and that would be equal to the net profit from the income statement minus the salaries. And we have 135,000 minus 90,000 in salaries gives us 45,000 to share in the ratio of 3 to 2. Okay, so we will get the equity being the fixed capital, the current accounts 3 to 2. This 45,000 that we got here, shared 3 to 2, and it gives us total equity of 827 and 618. All right, the capital will remain fixed, so you do not add these onto it. You just show these as the investment in the business. All right, one other additional thing: the partners will pay their salaries in cash. This is necessary for their current account balances to be in the ratio 3 to 2. Here, it will only show the remainder of the profits after the salaries, which would be in the ratio 3 to 2, because the salaries would have been paid 90,000 already. Okay, let me go over that again. Statement of changes in owner's equity. First, we have the workings. Current accounts should be equal to the net profit minus the salaries, which would be 135 minus 90,000 in salaries, 40,000, 45,000 each. That give us a remainder profit of 45,000 to be shared 3 to 2. So the current account should just have the profits being shared 3 to 2 if it is to remain in the ratio of 3 to 2. Okay, so when we add the fixed capital at the current account, we will get their equity. So this is a statement of changes in owner's equity. Note here, the partners will pay their salaries in cash. This is necessary for their current account balances to be in the ratio 3 to 2. Okay, if we do not pay them in cash before, then their salaries would show up in the current account as unpaid, and this balance would no longer be 3 to 2. Part B, list 3 possible reasons why a business partnership may be dissolved. 2. Explain the difference between judicial and non-judicial dissolution of partnership. And 3. Identify 3 steps required to dissolve a partnership. 4. Identify 4 benefits of operating as a cooperative. And 5. State 2 advantages and 1 disadvantages of a sole proprietor. 3 reasons why a partnership may be dissolved. Any 3 of the following: retirement of a partner. Okay, anytime a partner leaves or comes into the business, the partnership would have to be dissolved and a new partnership starts. Okay, so retirement of a partner, death of a partner, bankruptcy of a partner, the partner is no longer desire to continue in business, a partner is found guilty of misconduct. So those are all reasons why a partnership may be dissolved. The difference between judicial and non-judicial dissolution of a partnership. Okay, the answer is in the term itself, judicial. One is where the court intervenes, and the other is where the court does not intervene. So, non-judicial dissolution of a partnership occurs when there is no need to apply to the courts for an order. An example is when a partnership has been entered into for a fixed period of time and the period of time has ended. Judicial dissolution of a partnership is when a partner applies to the courts to end a partnership. An example of this is when one of the partners has been found guilty of misconduct and likely to prejudice the carrying on of the business. Steps required to dissolve a partnership. These are the order in which it may go. First, you dispose of the other assets, then cash and bank. You share any profit from the disposal of the assets to partners in the agreed ratio in their capital accounts. Okay, so you're going to share the profit in the capital account. And you're going to pay the creditors next, then pay any partners' loans, and then you return to the partners the balance on their capital account. Okay, so it should go in a similar order. Four benefits of operating as a cooperative. I have given you here 6. You can choose any 4. Voluntary and open membership, democratic control or one man, one vote, limited interest on capital invested, economic participation of all members in the results of operations, continual education from members, and cooperation with other cooperatives. Okay, so any four of those would suffice. Two advantages of a sole trader. One, no taxation at the entity level. This means the business itself does not pay taxes, although the sole trader himself as a person would pay personal income tax. Okay, but the business itself does not pay taxes. It does not share profit with anyone. All of it belongs to him because it comes from his personal effort. One disadvantage of a sole trader, he has unlimited liability for his debt. Okay, all the debts are payable by him and he's liable for it up to his personal possessions. Sunshine Bakery existing share capital is 400,000, 800,000 ordinary shares of 50 cents each. The existing shares are traded on the Barbados Stock Exchange at a price of $2 each. The directors decide to make a rights issue of 2 for 5 at a price of 150 each. Calculate how many shares will be issued if all the rights are taken up, show all workings, prepare the journal entry without narrative to record the transactions. The workings would be 800,000 shares by 2 out of for every 5, where 320,000 shares would be issued. The cash would be 320,000 shares from here multiplied by 150 will give us 480,000. The ordinary share capital would be 300,000 shares multiplied by the par value, which will give us 160,000 shares. The share premium would be the price here of 150 minus the par value of 0.5, that will give us 1, and we multiply it by the number of shares issued, we'll get $320,000. Therefore, the journal entry would be debit cash 480,000, credit ordinary shares 160,000, and share premium $320,000. Okay, that brings us to the end of module 2.